Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Friday, June 16, 2017, looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And we're looking at the daily chart, and what you see is the S&P 500, and wait till you see this. This is pretty amazing stuff. So the S&P 500 pierces through the 20-period moving average today and makes a low, and we'll talk about that in a second. But it had a dividend today, or it went ex-dividend, which means the price is reduced. So the actual S&P index, the cash index today, finished up 69 cents. And just to give a comparison, let me bring up the cash S&P index. So here it is, finishing up 69 cents, basically flat for the day. And you can see here the low of the day today was at the 20-period moving average, and when you just get the look of the daily chart of the SPDR, it's slightly below the 20-period moving average, meaning the low of the day, and we're finishing down $1 or 0.4%. But that's only resulting from, or as a result, from the dividend. Okay, fine. But what's fascinating is, with all that wrapped together, the dividend and the fact that we were down earlier in the day, finishing flat for the day in the S&P cash, but early in the day we were down. And so where was the low of the day? Well, check this out. The low of the day was, on the SPDR, 241.63. What's the low of this candle? 241.64. We had a consolidation for 4 days and a breakout candle, and we came back to test the low of the breakout candle, broke it by 1 penny and reversed higher, including the dividend wrapped into that story. That's not an accident. There's no coincidences. This is the way the market works. It's based on computerized trading, mathematics, and certain price levels. And if you understand how the market works and how it trades and how and why it trades to certain levels and tests certain levels over and over and over again, then you can find success in and around these markets. And that's really what my goal is in trying to explain these things to you in bits and pieces each and every day. When you see something like that, you know that there's no coincidence that the SPDR traded down to that number today, breaking the low of the 1st of June by 1 penny and then reversing, including the dividend. That's not an accident. You know that. You can look at that, and a rational person, you don't even have to be a trader, a rational person can understand that that's manipulation, if anything else. All right, going on. And by the way, that doesn't mean you can't make money in the market. As long as we understand how the markets trade, that's fine. Let them do what they do, and we'll keep riding the coattails over and over and over again. Looking over, oh, you know what? This is Friday, so it's an opportunity. I want to take a look at the weekly charts. So on the daily chart, at the end of the day, there's nothing wrong with the daily chart. We're above the moving averages. It's in a bullish consolidation pattern. This is building energy for another move higher. When you look at the weekly chart, that just confirms the bullish consolidation pattern. The only challenge is what this chart is telling me. I wouldn't be surprised to see another week of downward pressure in the market, potentially testing the low down to 240.64 is the low of the week of the 1st of June. Doesn't have to get that low, but certainly we could have one more week where we have another set of downward pressure days, if you will, another 2-3 days of downward pressure in the market, putting in 3 weeks of sideways activity, making room for another move higher. That's more likely to me. The more time that they eat off the clock, the more pronounced the move higher can be, and the higher we can go, if that's going to be the case. But either way, the market is poised to push higher, even if it tests lower levels first. Either way, the net result is higher prices coming between now and at minimum of the middle of July and potentially beyond. Net, nothing's changed. Okay, back to the weekly chart. And we'll go over to the IWM. And the IWM was flat today. And as you can see here, the divergence between the IWM and the SPDR is essentially the dividend. So they were on par today, traded on par. There's no leading indication one way or the other. And you can see here that this week, the IWM, namely today, early in the day, came down, made an attempt at the 20-period moving average, didn't get there, made an attempt at the low of the candle from the 8th of June, which comes in at 138.74. Today's low was 139.28, and then we reversed off those levels. This is a bullish pattern, building energy for another move higher. Now, if we don't move higher right away, we could certainly test some lower levels, and still there would be nothing wrong with this market. And when you look over at the weekly chart, you can see here that this week's close was good. We closed above, very comfortably, above the 138.60 level. We're just riding the upsloping trend line that's drawn in, dating back to 2011. And that's all we're doing. We're riding the trend line. This is a bullish chart. There's nothing wrong. It's certainly on a weekly time frame. We're above all the moving averages. We have an up move, sideways consolidation, above the moving averages. This generally promotes another move higher. So on a weekly basis, daily basis, nothing wrong with the IWM. It's spelling higher prices coming. When you look over at the VIX by chance, the VIX had a little bit of a down move today, even with the market mainly flat. That tells you there's no fear out here. There's no put buying. We had options expiration today, and mind you, it was a quadruple witching options expiration week, which means that 4 asset classes were expiring, and that means there was a lot of jockeying for position around the close today, around the open and the close, and essentially the market was relatively quiet, relatively flat, which means there's not a lot of fear out here. There's low volatility, which has the propensity to push prices higher. That's what low volatility does. The path of least resistance becomes higher. If the VIX pushes lower, below 10, even below 9 or into the low 9s, high 8s, the VIX would be a buy in those areas. You begin to, and the way to trade this, if you're so inclined, if you're a person or a trader that is okay with buying call options on the VIX itself. That's the way I prefer to trade this vehicle. I don't love the VXX. It's not a true tracking index or tracking vehicle of the VIX. It works when it works, and it doesn't work when it decides not to work. I buy call options on the VIX, and what I do is I go out far enough to where I never buy them all at one price. I begin to collect them. I may buy 5 or 10 at a time. Everybody has their own way of trading. I'm just giving you how I just tend to trade this vehicle. So I will collect a few at a time, out several months at a time, and if we get down below 10, I will begin to do that again. And then when it pops up, I sell them, and you just trade the VIX back and forth, back and forth. I don't buy puts on the VIX. I just buy calls when it gets down to a ridiculous area, and invariably each and every time it pops back up. And this time around, when I do buy them in and around 10, 9, 9.5, whatever it winds up to be, I'm going to anticipate holding them for a period of time and not necessarily look to unload them at 11 or 12. I think that we could catch at least some of them. I'll unload some of them, but some of them I will want to hold if we do get a severe or serious correction in the market, more so than we've seen yet this year or in at least a few years. Then I want to be in the VIX for that correction. That will be one of the vehicles where I would be able to take advantage of a meaningful correction across the stock market. All right, going over to the transports. This market is extremely resilient. You see the transport's up a few points today, but the point is that it's just in an uptrend above all the moving averages. The moving averages are sloping up, and the 20 moving average and the 50 moving average are beginning to break apart. And in upsloping and breaking apart at the same time is generally a sign of strength. It's a signal that the transports want to trade higher. That's what's going on here. So this is a bullish chart. Higher prices coming in the transports. Not a lot else you really need to know. The first going to challenge the highs over here, which come in at 95.69, 96.39, and beyond that we could break through and then trade to new highs if they're so inclined. Nothing wrong with the transports, bullish chart. The wild card here and the Lone Ranger that doesn't have a bullish chart above all the moving averages and everything looks hunky-dory. And by the way, before we go on to the NQ and talk about the NASDAQ, we'll go to the weekly chart of the transports. And again, closing above all the moving averages everything is bullish. And even from a longer term perspective, when you look at the monthly chart, you can see here that this is a bullish consolidation pattern on the monthly chart that is potentially beginning to break to the upside. You can see it unfolding this month. So that's important information. I like to look at the long-term charts, specifically on Fridays. I look at them all the time, but I like to look at them on Fridays in particular in detail, because the weekly closes, and then I like to look at the monthly closes also, of course, at the end of each month. But the weekly closes are extremely important. They're very telling. They're much more important by a magnitude of 5 than the daily closes, okay? So nothing wrong on the transports, weekly, daily, any chart. Okay, back to the NQ. So on the daily chart of the NQ, and this is the same for most of the tech names, all the charts, not all the charts, most of the charts look very similar or the same. So the NQ looks the same as the Qs, obviously, and you have your Google Ls that look very similar, and your Amazon, which caught a bid today, and it caught a bid today on the back of a buyout announcement of Whole Foods. I think that's interesting. So Amazon was up today after being down earlier, but the chart looks similar, minus today's bid. You have Google. Did we just look at? Yeah, Google we looked at already. You have Netflix. Netflix looks the same. It's a bearish pattern. And so these charts aren't out of the woods yet. In fact, we even have the exchange-traded fund we looked at last night, which is the S&P Select Tech Spider Fund. And this also looks like the NASDAQ, like them all. They all look the same. So this is a bearish pattern, hovering or building energy, trading right above the 50-period moving average. So the reason I don't love the NASDAQ and the NQ is because, and I've always talked about this, it's top-heavy, and it has too much weighting on the Apples, Googles, Netflix, Facebooks, Amazons, and so therefore it's reliant only on those, top 5, maybe 10 names, right? NVIDIA's and now Tesla. And so, Tesla's the new Amazon, Tesla's the new Google, and it's pretty incredible when you look at some of these stocks and where they have come from and where they've gone to. But right now, the tech sector looks relatively weak. Now, we can certainly spike higher, and we can correct the look of this chart in short order. That's absolutely possible. That could happen at any point in time. But what we do is we look at the chart in front of us and we say, what's the highest probability next move coming? And out of this, the highest probability is for a move lower. Now, it doesn't have to be a big move lower, and it could be just to this double bottom area in here, okay? But nevertheless, the probabilities say that the next move in the NASDAQ is to the downside. And if that's the case, we would expect some kind of a downdraft across the other markets. But that's what I see. While the other charts look bullish, the NASDAQ looks bearish on the daily chart. When you look over at the weekly chart, there's nothing wrong with this chart. We're above the moving averages. You've got nice spacing in between the 20 and the 50. This is telling you the chart's bullish, so there's really nothing wrong. The daily chart says it wants to go a little bit lower. The weekly chart says even if it does, it makes no difference. It's still in an uptrend poised to go higher. So my point in showing you this is even if the NASDAQ comes lower next week and takes the rest of the markets down with it temporarily, and that's the point, is I think it would be temporary and you can use it as a buying opportunity. There's still another leg in this market coming that's higher. Now, we'll know it if it's not a buying opportunity in short order, because I know the levels that if the market should get below, that takes the bullishness, if you will, off the table. So I'm not going to be afraid to buy the dips in here, looking for another push higher. I know where I'm wrong. I know where the market is turning bearish versus bullish. And just without even getting too technical on you, I can give you 2 levels right out of the chute. Any weekly chart close, in fact, a daily close for sure, but weekly chart close, absolutely, below 55.58 on the NQ is bearish. That means lower prices are coming. And if we get below 54.40, get out. I mean, that's the bottom line. Now, that's a far cry from where we are now. I'm not saying anybody has to stick around that long if you bought it Monday morning, and I'm not saying do that. I'm just saying that pullbacks are meant to be bought until further notice. The trend is your friend right up until the very end. All right, moving along to the gold market. Gold saw a downdraft this week, and I'm not going to start in the weekly, but I am going to go to the weekly, and I'm going to go to the monthly. So gold, I would have thought would hit the 200 period moving average today. We didn't do that. We're in a area of support in between 258 to 250 is definitely a level of support. Look at all this chart consolidation where the last breakout occurred. You had another series of chart consolidation at the same level. It stands to reason that this level is supportive of the market. Once again, we talked about this a couple of times this week, so nobody should be surprised. The point is gold poised to rally, or is gold going to break down further? I think gold is going to break down further. It could certainly rally. I have no problem with that, but I just don't think it's going to. Let's look at some longer term charts, and let's take a look at why. So from a longer term perspective, right? So this has nothing to do with what happens Monday and Tuesday. We're into moving averages, so there's some support in there. But I can make a case even from way up here or even right here. Either way, it doesn't matter. That this is a wedge pattern that will generally play out to the downside. That's number one, okay? So even if we move higher, until and unless we close at a minimum above 1350.10, right? 1350 spot 10. Until we close above that level, this is a bearish wedge pattern on the weekly chart, okay? So this takes a long time to play out, and we can certainly wedge up higher, and this could take more months to wedge up to 1350 and still be in a bearish wedge pattern. So you don't make a trade off a weekly pattern for sure. But I just want to point something out that, below these moving averages, and this is really the crux of the conversation on the weekly chart, below these moving averages, okay, any close below these moving averages on a weekly chart, and this is extremely bearish, and you can see what I'm looking at here. I'm looking at a little bit of symmetry here. You have this down move, you have an up move. Now you closed above, a few weeks ago, you closed above this big up red candle. That's positive, but now you're back below it into the moving averages. So it's wavering here. So there's no clear conviction one way or the other on which way gold is going to go. But right now, my bias is to the downside. I think it closed the week this week weak. And that's where I'm going to leave it at that. When you look over at the monthly chart, you can see it more clearly, this bearish wedge pattern. And that's what I'm looking at. I'm looking at a down move and a bearish wedge pattern. Staying below 1286.60 is critical, right? We had that number identified for quite some time. We're below that number again. And you can see here where it wouldn't be out of the ordinary for gold to trade lower, completing the symmetrical move from this down move, the wedge pattern up to test not the highs, but at least, 2/3 up, maybe 50, well, more than 50, 60% up of this candle, and then the down move could complete somewhat of a symmetrical move. So that's what I'm looking at in gold. So I'm not a buyer of gold in here unless I'm given some kind of a signal. I'm not a fan of this level to be a buyer right now. If we see a buying signal, a high volume reversal day of some sort like that, that's a different story. But right now, just based on where we are price-wise, I'm not a buyer. I have to see some kind of a pattern to get me involved on the long side with gold right now. Silver, same routine. I think it's a poor close for silver. We didn't close below yesterday's low. That's okay. That's not negative, but it's nothing positive for silver here either. When you look at the weekly chart of silver, you can see here another, potentially symmetrical move working out here in my mind. I can see 3 candles down, wedge pattern, 3 candles down would take us to new lows in here. Not new all-time lows, just new lows of recent. And so I'm not a big fan of the long side. This is weak. It's below all the moving averages. The weekly chart is bearish of silver. And on the monthly chart, quite the opposite. It's not that it's bearish or bullish. It's just not as bearish as the weekly. In fact, this is, I can make a case. You got 2 bullish wedge patterns forming right here. All right, so you have one like this, and then you even have a larger one like this, and these will generally play out to the upside. So there's some conflicting information between the weekly, the monthly, and the daily chart of silver. So when you have that, you don't have to make a trade. There is no trade. That's the way it is. So is there a trade in silver today? No. Based on price, you should be finding support, but the support doesn't have to hold for another day or so. It could break down, absolutely. When you have support that's a very strong support, for example, a 50% retracement on a pretty good move, that'll definitely be support most of the time, but it doesn't have to hold for more than a day or two or three, and then it could break down, but it's going to be supported for at least a day or so. But here we are already for a couple of days down in this area. Doesn't have to hold. It could build a bearish pattern and go lower. So that's the problem. I don't see a trade here one way or the other. Just move on. And when one pops up and a pattern emerges, that's a different story. But we don't have one today. On crude oil, I think this was just a dead cat bounce. Nothing doing in crude. No volume today, so you can't read into it. It's just a 50-cent up move after pretty stout down move, 2 days in a row. Yesterday, day before. The day before was the drubbing. Yesterday was a little bit of follow through. So we need to see some kind of reversal day. Today wasn't it. We could still trade to new lows. We need more information next week. And we'll get it next week, one way or the other. So there's nothing we could do leading into the futures opening Sunday night into Monday in crude until we see a high volume reversal or some kind of signal that crude has bottomed, and we don't have that now. So when you don't have it, you do nothing. There's just right now a trade would be a gamble. It's just a bet. We don't do that. Looking at the bond market, again, the bond market continues to power higher. Yesterday was just a rest day, a pause day amongst an up move, a trend higher. This is a bullish market, a bullish move in the bond market continues to power higher. And again, in the face of higher equity prices, and something will give at some point in time or other. The FOMC comes out and they raise the target interest rates another 25 basis points to 1 to 1.25%. And while that has nothing to do directly with the 30-year bond, the concept of higher interest rates is in the air, and the Fed raising interest rates tends to funnel through to the remainder of the interest rate market. It doesn't necessarily happen overnight, but all in all, you would expect that interest rates would be higher in the face of the Fed saying higher interest rates. And what that does is it generally populates through the interest rate environment. And quite the opposite, we're having lower interest rates. And it does happen quite frequently whenever the market does the opposite of what the Fed says or what something else is. Earnings announcement, company beats earnings expectations, the stock drops. And then the analyst comes up with a reason after the fact why the stock dropped. And so the same thing happens with the Fed and interest rates. And, one of the conceptual theories can be, right, and this is just conjecture, but it can be that a rising interest rate environment is not good for the overall economy long term, right? It's going to slow the housing market. It's going to slow corporate borrowing. It's going to slow growth. It slows acceleration of growth, okay? Now, them raising interest rates a quarter basis point here or there, it doesn't have a large impact one way or the other because rates are so low and they've been low for so long that story about, rates going from 50 basis points to 2% is going to stifle the economy. I don't believe that to be the case at all. That wouldn't be the reason why the economy would get stifled. It would be something else. It wouldn't be interest rates. They've been so low for so long that it doesn't matter. So I don't believe that to be the case. But conceptually speaking, if that was the case, then you could see the case for why the Fed would have to, in the case of a slowing economy, and we could dip into a recession in the slowing economy, they could have to actually, come back in to stimulate the economy, lowering interest rates one more time, easing monetary policy, which would be a whipsaw in and of itself. The Fed, eases policy, eases tightens. They shouldn't be doing that. They shouldn't be managing the interest rate environment like they are, and in turn, they think like, they attempt to be managing the economy, but in reality, they can't manage the economy. They think they can. They think they affect unemployment or employment. They don't. They just believe they do, and that's fine. It's no big deal either one way or the other. It's just like whoever's the president at the time takes the blame or the credit for whatever the economy is doing. But in reality, the president has nothing to do with what the economy is doing. The economic cycles happen whether who's in the office of the presidency or not. An economic cycle, whether it's 8.5, 9.5, or 10 years, goes in cycles. And some presidents are the beneficiary of bull markets. Some presidents are the beneficiary of bear markets. And some presidents are the beneficiary of both. And that's just the way it works, but they do take the credit and the blame one way or the other. So the bond market going up in the face of a rising equity market still is a little bit of a head scratcher. However, rates won't go down for much longer. They could potentially go a little bit lower, which means higher bond prices. But at the right point in time, this bond market will be a fantastic, and I say fantastic, short trade. And we'll just wait. We'll be patient about it. And the dollar, we saw a pullback from the large up move yesterday into the 20-period moving average. No big deal. That's garden variety, common, the way the market trades each and every time. Not each and every time, but most of the time. It's just garden variety market behavior. Little pullback, about a 50% retracement of yesterday's large up move. That's normal behavior. So we'll see what happens next week. We'd like to see some more follow through to the upside, and that's what I do expect. And with that, we're going to leave it there tonight. It's everything I intended and wanted to discuss. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.